You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors.
Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. Today, Brandon and I are joined by Sam Parr, a serial entrepreneur who has built and sold several multi-million-dollar companies, to discuss how real estate and taxes play into his businesses and wealth creation for his family. If you're a business owner and curious about how other successful business owners think about taxes and real estate, you'll love this episode with Sam Parr. Hey, Sam, thank you for joining us today on the Tax Smart REI podcast. Would you be able to start just giving our listeners a little bit of background of who you are and where you're coming in from?
I'm an internet entrepreneur. Right now, I'm taking this call from Westport, Connecticut. So I'm an internet entrepreneur. I've started a couple companies, including one popular one was called The Hustle. It was a fairly popular daily newsletter. It's like a business newsletter that was read by maybe 3 million people a day right now. And I bootstrapped it to many 8 figures in revenue and sold it for many tens of millions of dollars. And then I also host a podcast that The Hustle owned called My First Million. I think last year that podcast had something like 90 million downloads and views. And then my latest company is called Hampton, which is a peer group for entrepreneurs and CEOs. And then I've got some side projects that I like to work on. One of them being Sam's List. It's kind of like Yelp for accountants that I'm just toying around with. That could be a thing, but I can be transparent. But I think it made $27,000 in May, so it could be a thing, but we'll see.
Well, I'll just comment on, we are currently looking into that, and I'm going to talk about that more with Brandon as we go along. So we're in that. We're trying to look into getting more established on that for sure. But yeah, thank you for putting that together, and we hope to be one of your top referrals in the future for sure.
I hope that you get lots of business from it. Have you gotten any business so far?
No, we're kind of just in the beginning phase of getting that rolling out. Yeah.
Cool. Yeah, we could talk about it all.
Awesome. Well, I'm going to jump into kind of a tax-ish type question. So you're a business owner. One of the things that we talk about a lot on our podcast is not letting the tail wag the dog. So as a business owner of multiple businesses, how much would you say you make decisions for your business, investment decisions, based on tax outcomes and tax savings? I'm just very curious to hear that from you.
Very little. The taxes don't matter. I mean, they matter, but like in terms of where I want to live, like taxes are like, it's like the 5th most important thing. The first one being like, do I want to be there? Is my friends there? Or my family there? Is weather there? And then like taxes are like a cherry on top, depending, or it could be really bad. And then when it comes to business, like it's a little important when it comes to deciding if I'm going to be a C Corp, because for my last business, The Hustle, I got QSBS. So my first 10 million in earnings was tax free. And then like I'm kind of aware that you can like stack QSBS, which potentially could be like many, many, many millions in savings. But basically when it comes to running my company, like the first thing is like make a product people love. The second thing is like hire good people. The third thing is like just like don't go out of business. And then like maybe like the 18th thing I think about is like the importance of taxes.
Excellent.
I kind of think that's how it should be, though, right? It's like Ryan said, you don't want to let the tax tail wag the dog, and you don't want to make tax decisions that negatively impact your ability to create wealth or build business. And you mentioned like location. You know, we get people all the time that are like, should I move to Puerto Rico? And I think it was, I don't know if he got it from somebody else, but where I first heard it was Alex Hormozy, who said, isn't the point of making all of the money so that you can live wherever you want to, not have to move to save some money? And
yeah, that's how I think. Like being rich is about freedom, and I can choose to live where I want to live. Now, if I want to live in Puerto Rico, which I don't, but if you do want to, cool. But if you don't want to live there and you move there for taxes, I think that's a weak move. That's a small boy move.
Yeah. Now, kind of along those same lines, though, you had a rental portfolio. And sorry, Ryan, if I'm jumping ahead, but you had a rental portfolio. Most people get into real estate to not only build wealth, but mitigate taxes. And my understanding is that you have subsequently offloaded the real estate portfolio. So talk to us about those decisions.
So basically, my background is like the first 2 years of my business, I paid myself like 20 grand a year. And then like the 4th and 5th year, I kind of paid myself, the last year I paid myself like something interesting, but still not like crazy. And then all of a sudden I made a lot of money. And so I was like poor, not poor. And I was like, A, what do I want to do with my life? B, what do I do with this money? And I had a lot of friends in real estate, and I was sick of playing on the internet. I was like, I want to do something that's like real that I could touch. So I bought like 3 different properties or something like that. And then I also invested in other people's deals. Investing in other people's deals has been awesome. I've had awesome returns there. But I was like, I'm going to get into Airbnbs and I'm going to own land and all this stuff. And I did it. And like, they weren't losing money really. They were making money, but I just sucked at it. Like, I wasn't good at it. It didn't fit my skill set. And I was like, I had to learn the hard way, but it wasn't that expensive of a lesson, that sometimes you should stick to just like what you're good at and just invest in other people's stuff. So I think investing in other people's deals fits my skill set a lot more than outright owning, which I did, because I was not in love with it remotely. I hated it.
So if you're looking at the difference between kind of pitting them against each other, real estate investing versus say acquiring or starting a new business, like how do you see like the main differences between those two? And maybe it's more of a question of who should get into either one of those, and just how do you see like, oh, this one's a better investment for this type of person?
You mean like starting a product-based company versus investing or like a service or something? Yeah, like, man, I've created tens of millions of dollars in wealth starting with $0. And I did that with the internet because it's amazing. The internet's awesome. And I know how to like, I just learned how to do it and it fit my skill set perfectly. What's crazy about real estate is, I'm not super savvy. So maybe you guys or your listeners are going to be like, oh, this guy's an idiot. But you basically need money to make money with real estate. I mean, I guess you could do like some weird like niche things, but you kind of got to be rich to get richer with real estate, or at least some type of wealth. And I always thought it was a lot cooler that I could start a business on the internet with $0 or a service and like have like a good ROI. But it also fit my skill set. And there's a lot of other guys that are like, well, if you're really good at real estate, you can get whatever, 15 or 10 or 20% returns, just raise a bunch of money and like go and deploy that. And that is cool, I guess. I just think it's cooler to start with $0 because that was the position that I was in. It requires way more analysis. So basically the skill set needed to start a company oftentimes is the opposite skill set needed to run a company. Meaning when you start a company, typically it's more creative, it's more art, it's less analytical. When you run a company, you have to look at process, you have to look at savings, you have to look at a lot of different things. Similar with buying real estate. It's all about, I learned this like after I got into it. Someone was like, you make money when you buy. And I was like, what do you mean? And they're like, well, you got to like do all this analysis and like make some assumptions, but a lot of it's like just math and Excel work. And I was like, I'm horrible at that. I can't do that. That's really hard for me. And so that's why I don't really particularly love it. And so when I invest in other people's deals, it's basically like, who do I trust? And I'm like, dude, just tell me like the most conservative potential returns that you're going to get. And if you're putting your own money into it, I'll do it too.
That's awesome. Another kind of tax-ish type question for you. What is the most common entity structure for your businesses? C Corps you talked about, I think for Hampton. Doing
No.
the QS?
No, Hampton's not a C Corp. Hampton's an LLC. That's because I own the business. If you raise money, I think with an LLC, well, you guys know more than me, but if you're an LLC, you could only have like 100 units. So if you're going to like raise outside equity, you almost always have to be a C Corp, where I think that's like the default. I've not raised any outside money. With the hustle, I knew I was going to sell it. So a C Corp made the most sense to be a C Corp. All my other businesses start as a LLC, and then eventually they mostly become an S Corp, but they mostly start as an LLC because that's just a fast and easy way to get started. But maybe you guys can like correct me. Am I doing it wrong? Like you could do you could be an LLC and elect to file as an S Corp, right? That's what I've done a lot.
Yes. And the 100 units, the 100 shareholders, you're probably thinking of the S Corp.
Oh, okay. Yeah. But I just know in Silicon Valley, when I lived in San Francisco, it was like default C Corp because you're going to eventually sell the company. And so I think for a company that you're going to sell, particularly if you're going to sell it 5 years after starting and you don't intend to take a lot of like profits along the way, C Corp, I think is like certainly the best. But if you're going to like make money along the way, I think it's also like the worst.
Yeah. The default for me is real estate is LLCs. S corps are for operating businesses that you're going to keep, and C corps are I'm going to go start a internet business, some sort of startup company, and then go sell it. To me, that's kind of the default, kind of making it oversimplified for sure, but absolutely.
What's it called in real estate where you is it a 10 what's it called where you don't 1031? I think QSBS might be number 2, but you could argue it could be number 1. In terms of like the best tax savings, QSBS, qualified small business stock, and then the 1031 are like they like are go back and forth for like the greatest like tax savings ever created. But the difference is that QSBS is way less talked about.
Yeah, 100% agree. I would say QSBS is one of the most misunderstood. And as far as I'm aware, one of the least audited as far as court cases that we've seen, things like that. There's just a lot of like uncertainty around that. So absolutely, if you're in someone like your shoes, a C Corp, I would have recommended, day one, as far as what I know now, and agree. It probably is number 1, even above 1031 exchanges. Yep.
And you can like stack it in a way where like your family can get, I mean, it's like insane. I remember learning about it and I was like, how is this legal? Like it felt illegal, like learning about it. So it was ridiculous.
Yeah. And like the way I see it, and Brandon, you feel free to chime in, the tax code is kind of all about, incentives. So the government is saying, hey, we want to have our taxpayers, our citizens invest money into this. Hey, we want people to build businesses, right? It's just unique that it had to be these very specific rules of C Corps and you get 10x this and up to 10 million this or whatever this like unique thing. But absolutely, it's about incentives and it's absolutely, to me, again, just number 1, even above a lot of the real estate.
I think they missed the mark on that one. The ideal outcome of like incentives, like I was just incentivized to sell my company and make money versus like not pay myself along the way. I mean, I don't know. That feels like, I don't know if the ideal outcome was what they wanted to.
I guess it all depends on who's lobbying and how many dollars they have.
Because it was insane. That's like a legal thing. And I've got friends that have made tens of millions tax-free via QSBS.
That's an interesting point. I actually never thought about that particular incentive like that. Because you're right. It does. It encourages you to sell. And is that what they intended to incentivize? I mean, they intended to incentivize the blood, sweat, and tears that you put into building a company, right? But is that overall good for the tax base,
Yeah, I don't understand how that fit the requirement, but I do know that like every couple of years they debate if they're going to take it away or not. So I don't think it's wise to build your plan according to it. But if it could fit within the plan that you already have, it's pretty awesome.
Yep. Similar to a 1031 exchange. They have been talking about taking that away.
I don't think that will ever happen. The little that I know about government and taxes in real estate is that like America is built on like 2 people getting married and also people buying real estate. That's like the 2 like institutions that like the government holds more sacred than like everything else. Like they want you to get married for whatever reasons, and they want you to buy real estate. And the people who own real estate, like particularly investors, like their lobbying is so awesome that nothing is ever going to happen. But that's a very uneducated opinion.
Here's a question for you. So you had the pains of operating your rentals, but how did you know it was time to sell?
So usually when I'm starting a business, I think of like, what do I have an edge in? Like here's the requirements. It's like a 3-point checklist. Well, number 1, would I find joy in this? Like, would this be cool and exciting for me? Number 2, do I have some type of edge or unfair advantage? Number 3, can this be like particularly big? And I define big as like tens of millions of dollars a year in profit. When I got into real estate, I was like, this is really exciting and fun. And then when like things broke or I had to spend more money, I was like, I don't get joy out of this because I'm not so confident in my analytical ability to like be able to like say there's a good ROI on this. Like I just simply was not confident in my own skill set. And so like a year in, I was like, even though this is making money, I'm not confident in my ability running this at all. And also, I think I'd prefer just investing in other people's stuff because I'm getting a 10% return. I know other people that are getting like 14 or 15, or I invested in a couple of deals that were development deals and we got 28% returns over 3 or 4 years. And I was like, dude, I should just invest with the professionals. I'm not a professional with this. Just because I have money doesn't mean I'm a professional. I don't know at all. So I sold it like 1 year in. No, I sold it 2 years in maybe, but I still own some stuff. But the main one that I spent like $1.5 million on I got rid of that after like 2 years maybe.
So there's a lot of people online that talk about how real estate is passive income streams.
Bullshit.
Cash flow. Okay, I was about to ask your opinion on that. What do you think about that?
No, it's a small business. It's a small business. If you're a real estate professional, you're just a business owner. No, that ain't passive. No, it's passive when I invest in other people's deals.
Talk a little bit about that aspect too. Are you investing in like large syndicates, or are you investing in individuals, kind of like as the money partner? What does that look like?
So one person who I do a lot of deals with, his name is Val. I met him in Hampton. He's in my core group. He got wealthy starting internet companies. He partnered with, I guess the guy was a general contractor. And we bought, I mean, he's put in, I'm not going to say his number, but many, many, many millions of his own money. And we bought like 3 or 4 or 5 vacant lots in Brooklyn, and we developed them. And the first like 2 or 3 projects, the profit was awesome. I think we got a 28% return over 3 years, something like that. Like it was like crazy, but he was always conservative. He told me going into it, like, I think we'll get 15% or something like that. He's like, if my math is right, like maybe we'll get 12 or 15, which would be awesome. And I was like, all right, that sounds interesting. And we ended up killing it. And so I was like, all right, I like how you downplayed it and you were conservative. Let's do it again. And so we've done a bunch of deals together. And so I guess I'm just an investor, I guess an LP. Am I an LP? Am I even using those terms correctly?
Yeah.
Sounds like it. Yeah.
Yeah, I think so.
Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Whole CPA, we worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2023 and 2024 tax years, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help, but for now, we'll dive right back into today's episode.
Sam, one other question I've got for you. Other than building businesses, investing in real estate syndications, are you doing anything else as far as like alternative assets, oil and gas,
No.
ATM funds? Okay.
Dude, so let me give you, I've got very strong opinions on that.
Okay.
And these opinions are, for me, it's a very personal thing. But here's basically what I do. I do some real estate stuff, but like it's pretty insignificant for my net worth. But here's how I view like net worth and investing. Every dollar that comes in, like to my household, 80% goes to VTI, I think it's called, which is like a Vanguard total index fund. And 20% goes to some type of either, right now, like the yield I get on like bank balances is like 5%, but like it's usually like an 80-20 bond, a bond thing. I have like a banker who does this for me, but it's just like all you have to do is keep this at 80-20 Vanguard and 20% bonds. That's all I want. So my net worth is basically that like lump sum. And then it's also a whole lot of HubSpot stock, which I received when I sold my company. My wife has worked at Airbnb for many, many, many years. So she owned a bunch of Airbnb stock. So we basically own that lump sum of VTI and bonds, and then Airbnb, and then HubSpot. And that's basically it. And then on the other side, I've got privately held companies that I take income from, and I deploy it to those things. And that's pretty much all I do. It's like the most simple thing, because I'm like wholeheartedly against buying individual stocks and stock picking, because I just don't think it's worth my time. And I'm incredibly happy. Like the way that I view my net worth and my growth is my personal businesses, I'm going to grow those quickly. Everything else, I'm more than happy with 7% returns. And that's all I want. And I want those returns while I sleep well at night and I don't spend 1 second thinking about it.
It's wealth preservation, right? I don't need to take incredible risks with the chips that I've already taken off the table. Makes sense to me. Now, I know that you've done like a bunch of surveys in Hampton on wealth and asset allocation and things like that. Have you looked at any of that data coming back and reallocated your holdings as a result? Or have you thought about it?
Well, it's solidified the fact that, and this is a really interesting insight, people who are great at making money via starting companies and running companies, they are not necessarily good at investors, but the majority of them, including myself, which I did with real estate, think that they are. So there's this massive delta between being a good investor and like starting a company. So like when you start a company, you're like thinking like, what does the market want? How do I make like this brand interesting or cool? How do I go and acquire customers? And then once you make money, it's like, how do I get whatever percent return I need in order to beat like the low effort, low risk option? And so many people in my position, including me, like I said, think that we are good at investing. The majority of them are not. And some CEOs cross that chasm of like becoming like, you've got like these amazing people like Warren Buffett basically he was an entrepreneur, and you've got all these like amazing people who start understanding capital allocation. But the vast majority of them don't quite like it's like a learned skill set that takes a long time. Whereas it's not just because you're good at starting a business means you're automatically going to be good at capital allocation. It's more rare that you have both than you have just one. And so that's like my big takeaway, which is we think that we are good at it, but the majority of us probably are not unless we put years of effort, just like we have at our other skill set.
The capital allocation conversation is an interesting one because I think you see that even outside of just investing, if you're running a business and you're starting to build a larger platform and acquiring other businesses, I think you see people falter there as well. It's actually been the thing I've been talking about, wanting to acquire other accounting firms. I think that we have a pretty good model that we can deploy and help other firms scale. But that's my hesitation. It's like, is this hubris? Like, do I know what I'm doing?
Well, yeah, it is hubris, but also you could know what you're doing. Like, I think that like anything, it's a skill. So like if you run a business, like we didn't know what we were doing when we started, but we spent years learning it. So I think you can acquire that skill set. It just takes effort and practice. And like, by the way, I agree with that premise. I have researched accounting over the last 6 months. There's absolutely an opportunity to acquire accounting businesses. The amount of inefficient accounting companies that I've seen out there is insane.
We could talk about this the rest of the day. Like,
I know, let's say this could turn into a 10-hour conversation.
You should 100% do that. So I started this website, Sam's List, and like, I'm not actually going to do this, but I'm like, I should buy these accounting businesses because they stink. And that's another thing, like where you have to look at so I told you that like, I think about like, what's my edge when starting a company? It's so funny. The edge you need to be a good accountant oftentimes is not the edge you need to be a great business owner, right? You want someone like pretty conservative, like who's dry and slow and steady.
Attention to detail.
Yeah, attention to detail, doesn't necessarily adapt to change quickly. And then you like start talking to these accountants and I'm like, yeah, you're horrible at marketing. You're horrible at like acquiring new customers and things like this. But there's a massive labor shortage for accountants right now.
Yeah, it's a very interesting time to be an accountant because the leads, like new business, is not too difficult to
not at all
obtain. Like you really just have to hang your shingle and you can win some clients.
That's what I've learned. Is what people have said. They're like, I'm turning away work.
Yeah. What we have learned at our firm, and it took us many, many years to get there. And if any of our ex-clients are listening, we invite you back. But it took us a long time to figure out the number one issue with accounting firms is how do you run an efficient tax preparation process? How do you do 12 months of work in 8.5, 9 months? And that is like, if you see anybody complaining about their accountants, that's what they're complaining about. Is like, I uploaded my stuff in January and I got my return on April 15th and I had to run down to the post office and cut a $100K check to the IRS and I'm pissed. It's like, yeah, you should be pissed. But on the accounting side, it's like, how do you actually solve that problem? It's very challenging to do. We have, I believe, for the most part, solved it at our firm over the past couple of years, primarily through pricing right, number one.
What's pricing right?
Pricing right? A lot of accountants will underprice tax returns. And when you underprice tax returns, you have no money for labor that you actually need to get the work done. So that requires the owners and everybody else to work 80 hours a week to get the tax returns out the door. So what we did is we kept increasing the price to try to figure out what is the balance between what a client is willing to pay compared to how can we smooth tax season out on our end for our team.
Got it.
So we were just able to figure that out. It took a long time, but I think now we're in a really good spot. And what we do is we pre-hire talent. So we go out to the market months and months and months in advance of the actual revenue need. And so they'll be on our team ready to rock and roll when that next tax season comes. And a lot of accounting firms are not willing to do that. It's funny, actually, I talked to other accounting firms about this, and they look at me like I'm crazy when I start talking about our tax prep margins because they're low compared to the industry. But then you look at our NPS scores and they're like through the roof compared to the industry. And again, that took a long time for me to figure out.
Right.
So yeah.
Yeah. There's like trends in PE. Like for a minute, it was like buying dentists, like buying a bunch of dentists and like rolling them up. I think that them buying mom and pop accounting firms is going to be a very popular trend because a lot of these folks are retiring and their kids are like, I don't want to do that shit. Like,
Yeah.
young people just don't want to do it at the moment. And there's a lot of old guys who are retiring and they got nothing to do with their businesses. So I think that there's going to be like some interesting things going on in that space.
Yep.
You think the PE interest is kind of this like cycle of the market where you've got all these kind of boomers retiring and
Yeah.
interesting.
That's what I think. Yeah.
Well, I think PE too. I mean, it's a really simple argument to make, right? Because if you're running a PE fund, undoubtedly you've had a terrible experience somewhere along the line with your accountant, and so you're like, "Hey, I can solve this problem." But yeah, I mean, we see PE just, I mean, they're jumping into the space. We get hit up constantly, and it's just all these searchers just looking for the accounting firms to buy up. And I think it's actually a good thing for the entire industry, though. There's a lot of accountants, a lot of firm owners that are very negative towards PE. But I actually think it's a good thing because these guys will bring a different angle on how to actually run a business.
As a customer, I'm okay with it. I like
Yeah. It'll make the incumbents like stand up better processes and really try to figure it out. It's always amazing to me, like how people just totally trash their clients, even online. They're just like, my clients suck. And I'm like, dude, I mean, how, is customer service a value of yours? And man, if you're willingly talking about it like that, it's just, what are your customers feeling, And I think accountants lose sight of that sometimes.
I'm very eager to see what happens.
Yeah. Yeah. But anyway, you're building a cool thing with Sam's List. Very, very, very cool to see that.
It started as a project. I was, so I hate flying. Like I can't stand flying. And so I'm completely sober. I don't do drugs or alcohol, except when I fly, I have prescription medication. And so I get a little hopped up on a very minor dose of Xanax. And I'm just like sitting there at the airport and I get a call from my accountant or something like that. And it kind of made me angry. I was like, this accountant sucks. I'm so angry. Why are they asking me this question now? They should have asked me this 6 months ago. And so I just make a tweet and I'm like, who has a tax strategist or accountant that they absolutely love? And I think I got like 300 replies or something like that. But I noticed that I got hundreds of people bookmarking the tweet. And I was like, that's interesting. Why are people saving this? Oh, they have a list of accountants now that other people have endorsed.
Oh.
And I was like, that's fascinating. That's kind of interesting. And while I'm at the airport, I'm like, I called Joe, my partner. I'm like, Joe, let's make this into a website. Let's see if we can get it live in the next 3 or 4 days. And so we build this website where we like get, all 300 replies. We made a website where we looked like the person had gone. So the endorser, so let's say Ryan's like, I love Brad as an accountant for these reasons. And so we list Ryan's review on our website where it looked like he actually came to the website. It was really just him replying to my tweet. And you could see Ryan works in this industry. He does this. So like I can wait if I think his opinion is interesting to me or not. But then we were like, shoot, there's still all this information that we need on these accountants because on their website, half of them tell us nothing. And so like we called like 200 of them and we're like, hey, can you tell me like how much you charge and what services you provide? What's like your ideal customer? What customer you would never want to work with? Mostly businesses or mostly personal. And so I like spent like 2 months like calling all of them. And then we made this website, Sam's List, samslist.co. And there's still a lot of stuff we have to add to it. But it was like, let's just create like a database of like interesting accountants. Because if you Google like best accountant, like currently as of today, I'm working out of Connecticut. It takes me to like the Connecticut's website of like Connecticut CPA or something. And I'm like, I don't know who any of these people are or how I can trust them or anything like that. And so there's really like no competition. So I hope no one comes to compete with me because right now it's kind of cool.
That's a really cool story. I didn't realize that it all originated from that tweet. I thought that tweet was like leading you into it, but I didn't realize that was just on a whim. And then it was like, wait a second, we've got something here.
It was on a whim. Like I tweeted that at the airport, and I was like, after 1 hour, it got. If you can go and find the tweet, it got all these bookmarks, and people are like, "I'm saving this," and I was like, a light bulb. I was like, Joe, we got to turn this into a website. It has to be live like immediately. I got to follow up with this tweet of like how I aggregate. Originally, I was just going to put it all in Google Sheets, and then I was like, no, this could be a thing, and so we did it.
Huh. I've seen some of these other like lists pop up recently too, just with like tech stacks and stuff like that.
Yeah, my friend Austin Reef and Alex Lieberman started this thing called Tech Stacks. I don't know what it's called, but yeah, I like that. That's pretty cool. I'm a big fan of that. What they're doing, and that's really neat. And it's just like fun, like dorks like nerding out on it, on stuff like that, and myself included. And so I think it could be a thing. I was like, Joe, we can't do this unless it makes money. And I think this month it made $26,000 or $5,000, and it cost us like 30 grand to get it started. So we're almost made our money back.
Well, to bring that full circle, that's how we got connected, Sam, with you.
Yeah.
A client of mine that I had been working with, he's like, hey, I got to introduce you to, Hall CPA. And then I had started emailing with you or your assistant or someone getting
Kimmy.
information. Yeah, Kimmy. Yep.
I did a bunch of the calls at first, and then we hired this one woman, and I was like, Kimmy, I can't keep talking. Like, I need help. Like, none of these people will call me back. I need help. So yeah, Kimmy helped me.
Yeah. And then I was just like, hey, Sam, want to come on our podcast? And you're like, yeah, sure. When do you want to do it? And I was like, oh, awesome. This is great. So that's full circle context for everyone else listening. How did Sam get on your podcast?
I'm courting the accountants.
Yeah.
Because like no one wanted to talk to me at first. And so I was like, I need to become friends with these people.
That's great. You've got a friend in the accounting business now.
We have a few. We've sent like a bunch of, like our site's tiny, but like the first week we got like 10,000 people to come to it. And so like a bunch of, it doesn't do 10,000 every day, but that week we got 10,000, and like a bunch of accountants got like a ton of customers, and they're like, why didn't you tell me like this was going to be a thing? I was like, I tried to, but like, I tried to like tell you that like I'm putting you on this website, and they're like, I would have filled out my profile more. I was like, yeah, I told you. And so now, but a lot of people got a lot of business from us. So hopefully we have more friends than we did.
Knowing kind of what you know now, Sam, and kind of the businesses that you've started and now sold, and just kind of like a broad statement, like, is there anything that you wish you could change in what you did, say, years ago? Or kind of another way to say that would be like, if you were to talk to your 10 years younger self, what would you go back and kind of give advice to your 24-year-old self?
I got a bunch of stuff. So like to get really tactical, pay yourself more. So I had probably $1 million in the business bank account. I was paying myself 40 grand a year. And I thought that I was being stoic and cool and all this, but it actually made me make a lot of mistakes because I was always desperate for more money. I should have paid myself a lot more money. Maybe I was paying myself 2 or 3 grand a month, 1 year actually. So it was like less than 40 grand a year. So pay yourself more if you can afford it. My plan when I started my first business was I wanted to get like liquid and wealthy by the age of like roughly 30, because I thought if I could set myself up at a young age financially, life would be a lot easier, which that is a true statement. And so I would tell myself that's a good plan. Definitely do that. That said, if you set up your business early on and make decisions differently than I made, there's a world where you don't have to sell your company and you could still like achieve a lot of like desirable outcomes. So my business, we ended up raising a small amount of angel investor money, and then I gave equity to employees. I didn't need to do any of that. That was a big regret of mine. So I don't regret selling my company, but I regret being in the position where I had to sell. Because if you give equity to someone or take someone's money, you have a duty to like give them a return, whether through dividends or through sale. And I kind of like locked myself into that position. So I wish I didn't necessarily go down that path. I think that when you start a business young, when I was a young man, I was 25 years old, I didn't exactly know what I stood for because my values changed, because I was still like, my brain was still kind of forming. I wish that there was a world where I could have understood what type of man I was and what my values were and what sacrifices I was willing and not willing to make at a younger age, because I didn't know what I was doing. And so I ended, like when I started my company, I was like, I want to hire 10,000 people. Fuck that. That sucks. Like, I don't want to hire, I'd rather hire 10 people and make way more money if that's possible. Like hiring people just to create jobs, in some ways that's cool. In other ways, that's just kind of a headache. And I wish I would not have fallen into that ego trap. A few other things I would tell myself. I think making money definitely will make you happier, but it won't necessarily make you happy. I also think, and this is so cliche, and everyone listening is going to be like, oh, that's easy for you to say. It's definitely more about the journey. Like you got to like enjoy this shit while we're doing it, because you don't suddenly become happy just because you hit your desired outcome. It's kind of silly to say, I'll be happy when this happens. I'll be happy when this happens. I can tell you I've achieved a handful of things that I thought that was going to happen, and that is not necessarily the case.
Yeah, those are great. Do you wish you would have not sold the hustle?
No, I was in a position where I owed it to people, including my family, to sell. If you take money from other people, you better, like, I took that seriously. It's like letting down your father. It's like, they trusted me. I better die getting a return. Like, it's like, that's a big deal. It was a really big deal. I felt honored that someone would take a risk on me. I was like, I can't believe you are putting your hard-earned money into this. So I owed a return. When I started the company, my goal was to get to 100 million in revenue. And keep in mind, we were a newsletter. I told people in the media industry, this can get to 100 million in revenue, and that's what I'm going to do. And they laughed at me. They're like, that's the stupidest thing ever. A freaking newsletter? I was like, yeah, if you do the math, I only have 3 writers. I bet you I can reach 5 million people. And like, if I have this many advertisers, like, just do the math. I was like, I already have 50,000 subscribers. So if I just extrapolate that out to like 5 or 8 million subscribers, here's the numbers. Like, this is just a math equation. And they laughed at me. So many people laughed at me. A founder of a really large media company that you guys all know of, he laughed at me and he hurt my feelings so much. And I was like, am I wrong? Why are these people think I'm so stupid? Like, this seems right. And I sold the business in year 4, we were on track to do 20 million. And I sold the business before I could prove those assholes wrong. But now my dear friends, my great friends, Austin and Alex over at Morning Brew, they're at a roughly 90 million in revenue. And so they proved that theory right. And so I regret that I didn't rub it in those jerks' faces who all made me feel like I was stupid for believing that this was possible. Because I think that like rage and proving people wrong, if you can harness it correctly, is like an awesome motivator. And so like, I remember I felt so bad that this guy who I admired, who was like 15 years older than me, and so he was kind of like a hero to me. He was like, dude, this will never make more than $1 million a year. What are you, stupid? Like, this won't work. And I was like, no, you could do it by this, this, and this. So I was so upset that I wasn't able to prove him wrong. But I'm happy that others have been able to prove him wrong.
Wow. Yeah, just from a newsletter, 100 million. I can't even fathom that. But Morning Brew.
It makes so much sense. This is so easy. It's like the easiest equation on earth. I'll do it for you right now. Let's say that you have 100,000 subscribers to your email. Okay. The way that email works is you charge per 1,000 sends. And so let's say that if you have a really high quality customer base, of which I did, it was like business readers. So people who buy like enterprise software and shit. So let's say I've got 100,000 of those people. I send an email 6 days a week. Okay. I charge $45 per 1,000 sends. So in 6 sends a week, I'm sending 600,000 times. Okay. So can you guys do this math for me? So do 6,000 times $45. What's that equal?
600,000 or 6,000?
So here's the equation. 600,000 subscribers divided by 1,000 equals what? 600, right?
Yep.
So 600 times 45 is what?
27,000.
Okay. So that's how much you make per week with 100,000 subscribers. Is $27,000. Okay. Now, let's just amp this up. Let's say that you have 5 million subscribers and you're getting $45 per 1,000 sends and you're sending 6 times a week. What's that turn out to be? So 5 million would be, so that'd be 5,000 times 45. So what's that equal?
225,000.
Okay. What's 225,000 times 52?
11.7 million. Am I off? I think I did something wrong.
I think you're off, right?
Okay.
Are you? Are we
I feel
off?
like I'm off. Yeah.
I believe that gets you into tens of millions. That should get you into tens of millions. And then I was like, so if I have this audience of however many people, I can create this other product that gets me to this much revenue. So anyway, like I just did all the math where it worked out to where I'm like, dude, this is interesting. So look, it's 5 million. 5 million divided by 1,000 equals 5,000. 5,000 times 6 is 30,000. 30,000 times 45 is, yes, if you had 5 million subscribers and you're getting $45 per CPM, that gets you to 70 million in revenue. Sorry,
Do you
I
think
went on this long math thing, but
no, it's all,
I got
that
it.
was awesome.
I wanted to
the same
prove a
number.
point that like you could do this math
do
where
it.
it's like that gets you to 70 million in revenue. We're getting close.
Well, so somebody's like listening to this and like, oh man, I want to go launch a newsletter business. Is that a viable business to start today?
It's viable, but it's harder. So the reason why it worked for us and the reason why this guy laughed at me was because no one was doing it. But when we started, it was basically us, the Skim, and Morning Brew. None of us knew each other, but we all came to a similar conclusion, which is if you're on your iPhone and you click the Apple or Gmail app and you're looking at a screen of text, why is that any different than if you're on Chrome or something else? And we're like, so with an email, the way it works is someone subscribes to you, so they give you their email, and you only need to send them 1,500 words per day to get their attention constantly per day. And when I started the company, I wrote all the emails. But like once you start making money, you're like, I should probably get like 2 or 3 other writers in case someone gets sick. But basically, you're sending 1,500 words per day. Whereas if you're BuzzFeed or your whatever website, you have to write hundreds of articles per day in order to get a similar amount of traffic because each article will get like 20,000 views. Whereas with email, just 2 or 3 writers can consistently hit however many subscribers you have per day. You know what I mean? Like you get like the math behind it. And that was the conclusion that we all came to independently. Now, because we got famous, because Morning Brew built a huge business, because a handful of other people built big businesses, the secret's out. And so I think it's a lot harder in the sense of there's way more competition for a reader's attention. When we started, it was novel. It was cute. It was interesting. People like thought it was like, oh, this is kind of funny. I didn't know that this is like a thing. Yeah, I'll be part of this. I love this. Now, there's way more people doing it. The difference, though, is when we started, there weren't any software or tools to teach us how to grow our subscriber base. So all 3 of those companies that I mentioned, we all independently kind of came to similar growth conclusions on how to grow, but we had to learn it 100% by ourselves, and there wasn't anyone teaching us, and we just kind of made it up. Now there's way more playbooks, and there's ConvertKit, there's Beehive, there's all this software that has all these cool tools that are built into it, whereas I had to hire a developer to make all this crap on my own. And so it's harder in the sense of there's way more competition. It's easier in the sense that you don't need to make anything up anymore. Like it's all out there. If I were to start a newsletter again, I think that it's so like when we were growing, I think Morning Brew, the way that they grew was they got to like 4 million subscribers and then they launched multiple newsletters. So you can either do that or you can do what we did, which was grow one newsletter and then launch products to that same audience, which is what my strategy was going to do. That strategy, I think, takes longer, but can build a larger business. Morning Brew's strategy, I think, takes less time, but you're building an advertising-based business, which some would say that's a huge pain in the ass. My opinion is currently for the people starting right now, the likelihood that you're going to get to as big as I was or Morning Brew, which is millions of subscribers, I think that likelihood is quite low because there's just more competition. But I think it's cyclical. So I think in a couple years, however long that's going to be, newsletters aren't going to be cool again. And then you could get into it. But to do what I did now, starting today, it's way harder, I think. And I don't think you're going to ever be as big as I was. And that's not because I'm more talented. I'm not. It's because timing.
Awesome. Thank you for that, Sam.
Am I just ranting like crazy about newsletters? I'm sorry.
And 2 final questions as we kind of wrap up to be respectful of your time. Any final words for our audience? And keep in mind they're real estate investors. Any other kind of parting words, anyone listening to this and what you said?
Go big while you're young. Get after it while you're young. As I've grown and I've had a family. Do you guys have families?
Yeah.
As I've grown, I've got a young family. It's a lot easier when you're in your 20s and you have zero responsibility. Take more risk while you're young. And if you're older with a family, I think you should still take the risk, but you just accept that as you grow, it gets harder and harder and harder. So do more today and don't put anything off.
Awesome. Thank you, Sam. Where can people find out more about you, kind of hear what you're doing, follow up with you, things like that?
My podcast is called My First Million. I'm on Twitter, the Sam Parr. The website we talked about was called Sam's List, samslist.co. The company that is my actual focus is Hampton, joinhampton.com.
Awesome. And for our listeners on here, if you love our podcast, if you are a current client of ours, please go into Sam's List and endorse us. You can sign in either through X, Twitter, or LinkedIn. We currently have 1 endorsement so far. I hope by next week when I check this, we're going to be at 50 is at least my hope. So hopefully you'll be the top at that point, Sam, and you'll have no option but to tell all your friends about us at that point.
Yeah, I'm going to look at your profile on here and see if we can get you some more endorsements.
Okay. Awesome. Well, thank you, Sam, for joining us. It's been a pleasure. And we will see everyone else on the next episode of the Tax Smart REI podcast. Thank you.